Good afternoon and welcome to another episode of the Money Cog show. In this particular show, which is part of the moneycog.com website, we talk about stocks that we write every week for our Money Cog premium subscribers, of which you can find the description below and you can actually join for free. I think that's sort of limited for a limited time only. So definitely go out on the website in the description below and sign up. And actually, we do these free videos every week. So give us a thumbs up for this video if you like it, and also subscribe to our channel. And therefore, you can get these videos of insights of how a business makes money, their fundamentals, valuations, etc., which both me as the host Imran and Zaven as our lead analyst on this stock that we're going to talk about today discuss those stocks in a bit more detail. And you can also have a free read of the premium notes below if you sign up. So let's get into it. So today, Zaven, welcome. We're going
Thank
to be
you.
talking about Nvidia, if that's the right way of saying it.
Yep.
So why don't you give us a brief introduction into how the company makes money? What does it do?
Okay, so Nvidia is a designer, and well, you could argue it's a manufacturer, but we'll explain a bit more into that. Basically, it's making high-performance chips for computers. These are usually in the form of graphics processing units, or GPUs, which are used by gamers to be able to render high fidelity graphics, in real time for video games. You've also got it for professional visualization as well as animation, movies. All these applications basically require a GPU to do all the complex processing power, and NVIDIA is the ones who design and sell these computer components effectively.
So you mentioned graphics processing units. For those who don't know, what exactly are they, and do they even manufacture them? I think in your note you mentioned a bit about them finding third-party suppliers.
Yeah, so NVIDIA, the actual GPUs themselves are essentially a bit like a CPU in a computer. It's a processing piece of hardware that essentially gets fed information, it does some calculations, and then returns a result. Now, NVIDIA, despite them having lots of well-known graphics cards all over the place, they don't manufacture any of them themselves. They outsource it to third-party companies, and the reason for this is manufacturing semiconductor chips is complicated, to say the least. We've seen, I think people have become more aware about how complicated that is recently because of the supply chain issues. You had the Taiwan semiconductor manufacturing company, big one based in China. Turns out it was manufacturing more than half of all the semiconductor chips in the world, which has caused a bit of a problem when the pandemic came along. And they are a company that manufactures NVIDIA chips on the company's behalf, as is Samsung and a handful of others. And it's proven to be quite beneficial because it allows NVIDIA to essentially focus on what it's good at, which is the actual design of these chips, their architecture. It then hands off those designs to the manufacturers who then produce it, and then eventually they end up in the hands of customers through that route.
Okay, and what does that revenue sort of look down the breakdowns? Who buys these? Who are these graphic chips for? Is it particularly for gaming? Is it for other industries? Who are the end products and who are their customers? And maybe you can break that down as you do in the note on that revenue stream and the split of it.
Okay, so when NVIDIA first started, it was specifically targeted towards gamers. So it's not a surprise that is still a large part of their target audience. But over the years, because the improvements made by CPUs in terms of processing power slowed down, GPUs have become more popular when it comes to stuff like data centers. It's also a desirable way of doing all the simulations for professional visualization. So if you're an architect and you're trying to make a 3D model of an environment, you would need a GPU to render that out. If you're working in an animation studio or in special effects, a GPU, again, you need that processing power to do things quickly because it takes too long to start a processor. Those are essentially the three main revenue streams. You've got the gaming, the data center, and the professional visualization. But there's a fourth channel which has just started evolving. It's still relatively small, a small chunk of the overall revenue stream, and that's specifically to do with the automotive and robotics industries. So when I mean automotive, I'm talking about self-driving cars. In fact, NVIDIA's chips are already powering the self-driving technology found in car manufacturers like Jaguar Land Rover, NIO in China, and XPeng, which is another one. The last two are particularly good, big electric vehicle companies getting the headlights and highlights and all that sort of stuff.
Okay, so yeah, sounds quite I mean, all those sectors you mentioned seem to be going in the right direction. Gaming is only getting bigger. Electric vehicles can seem to get bigger, and How does that revenue then look over the last sort of 4 or 5 years, that trend then over the last 5 years, given
Okay,
what you've discussed about those different segments?
let me open up the report quickly so I can show this. Okay, so we're here in the premium report. For a quick breakdown off topic, we've got the reports essentially dive into almost every aspect of the business. We're looking at how the revenue stream is broken up, where the money's coming from, where they're spending it, and so forth. And obviously, I'm going to look a bit more into the financials. Later on, the report goes on to talk about management as well as the competitive advantages and the risks as well, which we'll all get to shortly. But in terms of the revenue stream, overall, in the last 5 years, it's obviously been trending upwards. It's been growing on around an annualized rate of 30%, slightly under. And the revenue stream, it actually is a bit lumpy. Now, this chart is somewhat misleading because the year 2020, you would assume the revenue stream has fallen during that period, but this is actually the fiscal year, which goes from the end of January to the end of January. So 2020 in this chart is actually over the time period between January 2019 and January 2020, before the pandemic came along. So in 2019, the actual year, revenue fell. Now, that's not too surprising. This is essentially a semiconductor business, and that is a cyclical industry. So there is a bit of lumpy revenue going on. But recently, things have started picking up, and it's not too surprising. There's two primary drivers behind that. You've got the latest generation of graphics cards with the real-time ray tracing capability, as Nvidia calls that RTX technology. We'll talk a bit more about that later on. But you've also got the sudden surging spike of cryptocurrency prices, and GPUs, as it turns out, are very good at mining cryptocurrency. So it's not too surprising that revenue has since exploded, really. I mean, it's a pretty massive jump between what's going on in 2020 to 2021. But
yeah, it sounds quite impressive actually where it's going. I mean, why don't you go into a bit more? I mean, revenues are great to talk about, but what about margins? How do the margins look? I mean, what does that do to the bottom line?
Okay, so when you think about a semiconductor business today, with all the supply chain issues and the manufacturing delays and lead times, you'd expect gross margins to suffer. You would expect the cost of manufacturing to go up. And that has increased, there's no denying that. But in the case of Nvidia, their gross margins have actually increased, suggesting they're generating more money now than they were last year. Their profitability has gone up, which is, odd considering. And that is, if you go into the details, you can see that the cost of manufacturing, because even though they're not manufacturing these chips, they've still got to pay the bill, right? They've got to pay for the raw materials. All of it is obviously sourced by the manufacturers, but, Nvidia has to pick up the tab. So what the company has seemingly been able to do quite successfully is simply pass the cost on to customers, and then some extra at the end, because profitability went up, which is obviously a very encouraging sight if you're a prospective investor.
Yeah, it makes you one of the advantages clearly is that it's got pricing power, and it can just charge whatever it wants. I mean, just going back into that then. Yeah, so profitability is great, and we always look at companies with profitability, and a lot of the time with accounts you can kind of fudge the numbers, you can be profitable, but what does that mean for cash? And cash is always an important element of what we look at, free cash flow, and what companies do with that free cash flow. We mentioned in a conversation I think previously about HP and free cash flow and giving it for share buybacks or dividends or reinvesting in the company. Sometimes they're not always that great. So share buyback, it's short term, but what do the cash levels look like at Nvidia? And I think from what I remember and reading it, it's quite large. And what do you think that means for the business?
Yeah, so today Nvidia has around $21.2 billion, I think, of cash just sort of sat there, which is, and it's not exactly pocket change.
They should give some of it to us to manage.
Yeah, it'd be quite nice, I think. It is a very large cash balance. And, on one hand, that's really good news. It provides a lot of flexibility that I would be extremely surprised if, the company suddenly announces in financial woes. By comparison, their liabilities are around the $4 billion mark. So they can, they're all good there. Yeah. But, it's, on the other hand, if you have so much cash on your balance sheet, yes, you can invest it into liquid money markets to get a tiny percentage return, but ultimately it's not doing anything. So the question then becomes, shouldn't they be doing something with that? And in most cases, companies either use their cash to fund new ventures, increase their R&D or marketing campaigns, or potentially even an acquisition. And if they're not going to do any of that, then in those scenarios, the capital, in my opinion, should be returned to shareholders, either through a dividend or share buyback, unless there's a large upcoming expense. In the case of Nvidia, they recently tried using a good chunk of their money to acquire a company called ARM Holdings. It did not go well. I'll explain why in a moment. Essentially, ARM, for those who don't know, they're essentially the semiconductor chip company that power most of the mobile phones today, whether it's Android, iPhone. Their technology is inside most of the smartphones. Now, that is obviously sort of a nice complementary business to Nvidia. It's semiconductors, but it's a different segment, different target audience. There's very little overlap between its existing products and what it was going to acquire, which is a good thing to see when someone's going to spend billions on acquiring another company. But the issue Nvidia ran into is that because it essentially would destroy any form of competitive field, the regulators said no. It's not going to happen. So I think Nvidia ended up spending up to just over $1 billion so far on all the initial legal negotiations with SoftBank, who are the company that own ARM Holdings, and it's basically gone down the toilet. I mean, if the regulators say no, it's like, what can you do? It's like you can try and convince them. Nvidia basically came out with a statement saying it's not worth the effort. It's just.
Yeah. But I guess at some point they might look at something else to acquire, given that cash and
yeah, it does raise an interesting point though. Has Nvidia reached a stage where it's so large that any form of big or massive acquisition, will that ever be allowed to go through? It does have competition in this space, especially from Advanced Micro Devices or AMD. But at the same time, there's really not that many other companies working in the GPU space. So there's sort of in a bit of a duopoly to some extent.
Sometimes I find that when you have that, they're earning a above average margin, and that might get eroded over time because they want more competitive. The regulators want more competitors in the field. So it'll be interesting to watch. But I think they still have some room to grow based on what you're saying, and in terms of actually their existing businesses and actually growing more market share in them. So that makes sense. And I guess with all these decisions and everything we're talking about, it all comes back to the management, doesn't it? It comes back to who is making all these decisions. And in your note, actually surprisingly, Nvidia is not a particularly old company in terms of most. In tech, it's maybe a bit older, but in terms of overall companies that you would look at from an investment perspective, it's only 27 years old, or that nature, 1993.
Something like that.
Yeah, it was founded in 1993 by Jensen Huang. That's how you pronounce it.
Jensen Huang, yeah.
Jensen Huang, yeah. So why don't you give us a bit more information on what you think of that management team and the way he runs the business?
So he's still in charge. He's a co-founder. And he's obviously been running the show since the beginning, really. Now, when we're trying to evaluate CEOs in particular, it can be a bit tricky because a lot of people like using past performance of the stock price, which over long periods of time, can be a good proxy to measure performance. But if they've only been there for 1 or 2 years, it's fairly meaningless. The way we like to judge instead is to look at how the employees think of the actual business itself. So there's anonymous employee websites all over the place. You can get some inside look. And the reviews for Jensen have been pretty extraordinary. In fact, the Harvard Business Review, big newspaper, they voted him the best CEO in the world in 2019, like #1 out of every other company. That's a pretty impressive achievement. And I'm not entirely surprised. I mean, obviously, it's well done him. But we often find that when you have a founder who's still in charge of running operations, the business itself has a tendency to be a bit more interesting than one without. And the simple reason for that is founders tend to be a lot more dedicated to the work. Their salaries and compensations tend to be a lot more reasonable. And more importantly, they're thinking long term. They're not thinking, how do I get the share price up X amount of the next 3 years because my tenure comes to an end. And as we're long-term investors, that's what we want. It aligns the interests of shareholders and management, which is often not the case.
That sounds quite promising. We always talk about, as you mentioned, founder-led businesses are always great. It brings me back to sort of the next point, which we want to look a bit more about, is management. Clearly, it's a good competitive advantage. We've talked about what they're doing, but what are the other competitive advantages or things that you think are important when it comes to NVIDIA that people should be aware of in terms of their strengths?
Okay, so we've already discussed briefly that the company has an immense amount of pricing power. The change in margins is a lot of supporting evidence in that, and there's other traits as well, which we go into more detail in the actual notes. But a lot of what at the core of that pricing power, it comes from a technological edge over its competition. Nvidia was one of the first companies to come up with real-time ray tracing, which for those who don't, okay, it's being marketed as this giant win for gaming, for more realistic graphics in real time, which is true. But in reality, it has a lot more interesting applications when it comes to professional visualization. Without going too deep into the science, which is, ray tracing is essentially where you're simulating light rays bouncing off sources going into a virtual camera, and that's how you end up with your final image. And with games, they don't take that approach. We do an approximation of that calculation using rasterization graphics. If people want to learn more about that, I suggest they look it up. It's a pretty complex topic. Now, the problem with ray tracing is it's a very computationally expensive process. So if you're working at, I don't know, Pixar or DreamWorks or any of those animation studios, and you've got your scene ready and you want to render it out, it can take entire server farms to make all the calculations, get a good quality, final image if it's going to cinema. With the RTX technology, it essentially brings all of that process just not okay. The real-time ray tracing, you take it granted, so it's still early days technology, especially in the ray trace rendering side of things. But it essentially accelerates the process so much that one day, someone with an RTX powered graphics card in their living room could render out an entire bloody movie without needing an entire server farm, which is just, quite impressive, really. It sort of makes the technology somewhat obsolete to some extent. Maybe we'll see.
Yeah, I mean, sounds like you know a lot about the space. So which is one of the areas we talk a lot about, which is your circle of competence. Sometimes us as individuals, through whether it's our work or whatever we do as a career or our passion interests, we develop a lot of knowledge within a specific industry and sector, and those tend to be the places you should look at for investments because you've got a great unfair advantage in those areas because you've got the knowledge. Something in this case, it seems like you know quite a bit about. Sounds like a strong, promising company. A lot of positives there. Market, they've clearly got a good, strong market share. Given that nobody wants them to buy any other company. They're not allowed to the regulators. So what are the weaknesses? What should we be wary of?
So this sort of ties back into the whole way it manufactures its chips, essentially. Now, on the one hand, as we discussed, it's advantageous because the company can focus on its core operations. It doesn't have to faff about with the complications of running a semiconductor factory, which is an absolute nightmare. But on the other hand, you have the issue where NVIDIA has very little control over quality once those chips come off the factory line. There are obviously quality assurance guarantees put in place by the manufacturers, otherwise they'd lose customers very quickly. But it's essentially too late for the group to inspect by that stage. Now, the other issue it lends to, because especially today with the manufacturing lead times being so long, the company effectively has to predict the volume of demand from its customers for each generation of its graphics card, including the different models, which have different processing power and prices accordingly. So if it over predicts the demand for a specific chip, then it's going to lead to an inventory buildup. I think in the past, AMD, one of its chief competitors, had a big issue with this. And on the other hand, if it under predicts the amount of demand people want for these chips, then they, if gamers or data centers can't find the graphics cards they need to fulfill their tech requirements, they'll go to a competitor who can provide them.
Yeah, makes sense. With that, we mentioned the competitive advantage, we mentioned the potential problems. What's the valuation? Is this something that is a stock that's worth looking at seriously to buy in the portfolio? And people can look a bit more about the assumptions you've made in the valuations in the full note, which you can see the description below. But maybe you want to go through just quick high level your valuation process, how you came up with it. And
okay. So when I did the stand, with most of our notes, there are a few exceptions. We often do discounted cash flow models where we're projecting forward the revenue stream. We list our assumptions and stuff. When we did the normal approach for this company, we found a valuation which suggested the stock was insanely overvalued to the point of insanity. So like, okay, we're missing something here. So we ended up finding a report by Allied Market Research that predicted that the global GPU market would reach around $200 billion by 2027, so in 5 years. By comparison, today it's currently worth an estimated 35 billion. That's a pretty massive growth opportunity there. And when we put those numbers into the model, suddenly the valuation started making a lot more sense. But in order to justify Nvidia's current share price, which I think at the moment it's around $270 per share, the company would effectively have to grow its bottom line by just over 30% for the next 5 years, which, is it doable? Sure. Is it difficult? Definitely. So I think investors and the market in general may be being a bit optimistic with the current value of the stock, but I wouldn't say it's completely absurd.
One thing you've got to assume though is that if they don't do anything at all and they maintain their market share, then do they maintain the same market share? So if you assume they own, let's say, 67% of the market today, do they then own 67% of the market at that 270 valuation?
That's another concern, yeah.
And you could sort of say, well, okay, not 70, but let's say 30%. It drops down half. So 30% of a 270 billion. So that potentially is the revenue stream.
200
so
billion,
yeah, that could give you an idea of what the revenue streams would be. And then you've got to think, well, what other players are likely to enter that space, which is why that market grows. So there's a lot of questions to be had, and I think well beyond this conversation here. But yeah, definitely.
It's an interesting point to make because speaking of competition, AMD, while it's often seen as sort of brewing in the background, like a shadow of what Nvidia is on scale-wise, the company has been making some impressive strides recently. The current generation of consoles, your PlayStation 5 and Xbox Series X and all that lot, they're all powered by AMD GPUs. And the company is now also beginning to enter the data center space where it's in direct competition with Nvidia. So whether or not the company can maintain its market share going forward, I think very much depends on its ability to continue innovating. Management does have a pretty generous research and development budget, but obviously the spending doesn't guarantee that you're going to be first to discover the next RTX technology, for example. So while it does have pricing power, that pricing power seems to be heavily tied with its ability to stay ahead of the competition from a technological standpoint. And now that AMD is obviously securing more contracts and growing the background, whether or not it'll be able to retain its current market share, we'll see. I
know it sounds like, I think it sounds quite interesting in terms of potential dynamic and competitive landscape, which is why you sometimes think, okay, potential for high growth, but you've also got to look at the risks of that growth and, like you say, the valuations and see it all makes sense. But we put all that together into what we call the COG score, which is quantitative and qualitative. And this score, people will be quite surprised of what it gets, and they can look at the full note below. So we won't talk too much into it because I think it's self-explanatory. We encourage people to go on the moneycog.com to read a bit more about how that's calculated, and they can read it in the note below. They sign up for free. But thanks for doing this note today. Next week, I'm looking at a slightly different company, probably rather boring, just paper. Looking at a company called DS Smith, which basically makes cardboard boxes. So it's rather exciting business, but actually sometimes boring is sexy. So you never know. That might be an interesting business to look at. Thank you again.
Thank you, Imran.